Good morning. Welcome back to the Retirement Report. I'm Hank Parrot, your host. One of the things I was talking about just before the break was a little bit about the tax rates between the progressive tax code, capital gains tax rates always being lower than ordinary income tax rates. I'm going to expand on that as we go through this and show you, this is one of the tricky parts when you get into the tax code about you get some rules and it seems like, okay, I know how this works, and then there'll be some exceptions that kind of change that up a little bit, and sometimes maybe even exceptions to the exceptions, and we wanted you to understand all of this for a number of reasons. When you're making decisions about selling stocks or selling real estate, these are important rules to understand. When you're determining about taxation on your Social Security, when we're looking at whether a Roth conversion is a good idea, there are so many different opportunities out there for you to help manage the risk of taxes, help you minimize those taxes. Understanding these basics is so important as a place to start with that. So again, 3 categories of retirement income. We have taxable retirement income, we have tax deferred, and we have tax free. So we're going to take a closer look at those 3 categories, starting with the taxable sources of income, of retirement income. So for instance, investment sales or earnings from stocks and most bonds, etc. The taxable portion of your Social Security income, profit from selling real estate. And now if we look at those investments, those types of taxes paid could be capital gains tax rates, or it could be ordinary income tax rates. How you manage that, you get to kind of determine that to a large degree. Social Security, same concept. You can, this is taxed at ordinary income tax rates. However, you can control that in terms of how you set up your income. Profit from selling real estate, again, capital gains is under certain circumstances, and what we're looking at there mainly, if you're when it comes to real estate, as long as you end with any, even on the stock and bond, these are long-term capital gains rates, all right, to be distinguished between that and short-term capital gains rates, important to understand. In fact, let's take a closer look at capital gains tax rates. So capital gains, the increase between the original value of investment and the price when it's sold. So we want to go, let's see, go to the next one. There we go. Perfect. Short-term gains are earned on investments held 1 year or less. These are taxed at ordinary income tax. Now, that's an important thing. So if I bought a property and I flip it, basically, right, I fix it up and I put it immediately on the market and I sell it and all that within the first year, then I'm not going to get any preferential tax treatment on that. I'm going to pay short-term capital gains, which basically is the same as ordinary income tax rates. Now, long-term gains, if I've held it for a year, and many times investors will do just that, they're going to want to hold that property at least for that, 12 months and a day to be able to get the long-term capital gain rate, which is going to be lower than ordinary income tax rates. And these are taxed according to basically the long-term gains are taxed based on how much money you make. And this goes back to what we were saying. If you're, for a married couple age 65, right, 108,000 approximately is what your is the cap out at that 12% bracket. That's your adjusted gross income. If it is under 108, and that includes the gains. So I'll give you an example. Let's say I've got $50,000 in taxable income, and then I sell some stock, and I have $50,000 in capital gains from the sale of that stock. Well, combine those two together, that's 100,000. I'm still in the 12% bracket. Therefore, I pay 0 tax on that gain. So I don't have that 50,000 from selling those stock. I don't have to pay any taxes at all, 0. I'm just going to be taxed on the other 50, which might be Social Security or whatever other income source might be a part of that. So this is, again, understanding how that works. Because here's one of the tricky parts when it comes to capital gains. Once you exceed, right, married filing jointly, now they're just giving you the taxable income part. I'm adding in the standard deduction to give you the AGI, or adjusted gross income. Now, keeping in mind, once I cross that threshold for married filing jointly, now I'm going to, that $100,000 basically, or approximately 108, I'm now going to have to pay 15% tax on that gain. Now here's where it differs. Remember, I was explaining to you the progressive nature of our tax code, meaning that like your standard deduction you pay no tax on, the 10% bracket you only pay 10% on the money that you have from that, that first $20,000 over your standard deduction, then 12% on the next $63,000. So basically what I'm explaining to you there is that those tax rates, you progressively go up. Each time you hit a bracket, that's when you pay a little higher amount on the money that goes over that lower amount. Here, on the other hand, with capital gains, you cross that $108,000 threshold. Now, all of the gain is taxed. So in my example to you, if I had $50,000 in income, $50,000 in a capital gain, that's combined, that's $100,000 total income. That's under 100. I pay 0 tax on the $50,000 capital gain, long-term capital gain. Now, on the other hand, if that 50 turned into 70, and now I exceeded the 108, now I've got 120,000 in income. And just to show how this works, in fact, let's just have some fun with it, and let's say that income is actually 50, we'll call it 60,000. So now I've got 110,000 total. That's just over that 108, but that causes all 60,000 of my gain to be taxed at 15%. Think about that. This is so important. So if I'm selling stock, or I'm determining I want to sell some stocks, I want to free up some cash, one of the things I'd like to be mindful of, if I can sell it and keep it and stay in that bracket, for instance, I'd want to do that and pay 0 tax. And think about that. If I miscalculate and I cross over that cap of 108,000, now I'm paying 15% on the whole gain. So let's say $50,000 that normally would have been 0 tax, I'm now going to have a $7,500 tax simply because I wasn't aware of that rule and didn't pay attention. Well, usually it's people aren't aware. If they're aware, they're paying attention. So now you're aware. This is something you want to pay attention to. All right, let's take a look at the next slide, tax-deferred sources of retirement income. And I'm going to come back and talk more, by the way, about capital gains and an excise tax and some other things that go with that. So, but let's keep moving through this real quick. Tax-deferred sources of retirement income, like a pension, that's going to be taxed at ordinary income tax rates. Retirement savings from your 401k, IRAs, a TSP, thrift savings plan for you federal employees and military out there. Again, all taxed at ordinary income tax rates. Annuities, again, at ordinary income tax rates. Now, understanding with annuities, and I talk about annuities on here, in particular this year, we've spent even more time. When you've got a down market and you have some, and I know a lot of people get really nervous, and we hit bear market territory. Now we've regained about half, basically, back of those losses. So year to date, we had been up around, I think it was somewhere between 22 and 24% down on the market, meaning the S&P 500 index was down about 22 to 24%, I think, at its low point. Now it's down about 12%. So again, it's regained about half the losses year to date, most of that happening in July. So the first 6 months, not looking good. Had a lot of people very nervous. And so we're talking about alternatives, and with annuities in particular, specifically, in fact, fixed index annuities with no caps, and this is real important. So I want to really be careful when I'm saying to you about index annuities or annuities in general, to understand it doesn't mean all annuities are good. When I'm saying to you, for instance, that they can be good in a plan, you might replace some of your bonds in a portfolio, for instance, with fixed index annuities. And I've shared with you Roger Ibbotson, and now I think it's Barclays maybe has come out with another research piece, basically showing how the index annuities will outperform bonds, or have outperformed bonds over the long term, and they're less risky. So they can fit into a portfolio really nicely. But also there are a lot of other benefits that can come from them as well. Saying that, keeping in mind that that doesn't mean all annuities are created equal, of course. That's like investing in stocks. you know, how you invest is equally important, and what company you might choose, or how, you know, ideally, you know, you're going to have a portfolio that has thousands of companies. You're going to have that kind of diversity and protection. When it comes to annuities, same concept basically, though, is that there are some that are you would want to avoid, many of them in fact, but there are some that are very, very good, but you have to be selective and you have to understand them. And I'll go through a little bit of some of the things that you want to watch for. First and foremost, you would like to, you know, again, avoid annuities that have caps on them, meaning, and by that I mean fixed index annuities. In fact, I'll give you an example. I just had a couple in yesterday, and we were going over their portfolio, and they had a couple of annuities that they had purchased a few years back, and we were looking at those, and this is their first time clients coming in, and I'm going over getting them set up to do their planning, and I'm looking at the annuities and some of the sub-accounts. Now, this was a good company with, again, and the product itself was a good product. However, within the sub-accounts that they could choose from, about 5 of those out of 8 had caps, and those caps range from 2 to 2.5%. Well, we don't want cap. That means the most you can earn is 2 to 2.5%. Where on the other hand, if we look at, there were 3 other options within that, 3 other sub-accounts with no caps, good participation rates. They had a much better opportunity for growth. So here you got a good company with a good product, but you also have to watch what the sub-accounts, which ones you invest your money in. When we come back, I'm going to talk a little bit more about how the annuities fit in, and just to finish off that slide, the annuities, again, tax at ordinary income tax rates. Now there we're talking about on the earnings. The principal you put in, you've already paid tax on. Of course, it's not going to be taxed twice. All right, quick break. Join me here. I'll be right back on the Retirement Report.